Mike Tedeschi, Wealth Management Advisor at Perspective Wealth Planning with this week's market breakdown video. Got a lot to cover. The S&P 500 made a new marginal all-time high, which was rejected yesterday. We're going to dive in and take a look at the four major U.S. indexes. We are also going to take a look at commodities, specifically talk about copper, which we haven't taken a look at in a while. We'll also take a look at gold and silver. And oil, we'll check in with the U.S. dollar, and we will also take a look at the emerging markets. And as always, we'll take a look at some interesting breath-reading statistics to see where we are at. So let's jump right into it here. First and foremost, S&P 500 did make a new marginal all-time high in yesterday's trading session by a couple of ticks. Still didn't break that 3,400 level, and then we saw a rejection during the end of the trading session based on what was said at the Fed minutes when that report was released at 2 p.m. Eastern. That saw the dollar spike. It also saw gold drop sharply, and then overnight that trend continued. The S&P 500 is down about another 0.5% here overnight. When we're looking at this chart, this gap that we talked a lot about right here, that's really the level that the bulls need to hold on to, right? Making a marginal all-time high just by a couple of ticks and not really breaking out means we really didn't make that breakout yet, and we can still trade inside this range before ultimately pushing up. However, if we lose this zone right here, that could be looked at as that potential double top, and that would not be good. The next zone of support under that's right here at these gaps, and then really we would end up looking all the way back down about that 3,000 level. So a really bad place for the market to fail here for the bulls is right at that double top. We've been talking about that as a potential possibility here for weeks now. We take a look at the other indexes. The Nasdaq just continues to make new high after new high after new high. Grinded up all week. Did see the reversal just like the rest of the indexes yesterday off of the Fed minutes. But still well above that 11,000 zone. A lot of areas of support underneath. Been the clear leader. That is where capital really has flowed into this year, which makes a lot of sense when you look at how the world has changed. Everybody is, utilizing technology more, working virtually, ordering things online in much greater fashion than they ever had before. So tech makes sense that would be an area that saw some boom from what happened this year. The other areas of the market, we take a look at the small caps, mid caps. Looking at the Russell, we had a good push up, and really one of the ways that you could take a look at this right here is we have a move higher and a potential bull flag looking for that next push up, but we have all this resistance zone, and we talked about that right there at that 1,600 level. We haven't broken above that, and really need to get up over that 1,630, which would really put that 1,700 back on target for us, right? But a break from this would not be good. 1550 is that zone that we're watching there on the Russell. Underneath that, again, we play the 50s. Back to that 1450 zone would be the target. So really important for the Russell to hold on here. And when we look in at the Dow, very similar chart setup here with that potential bull flag over an area that was resistance, which could now act as support right here on the Dow, but a lot of overhead resistance as well. So if we lose this breakout zone, 27,000 is that next level, and then the next major level's back around that 25,000 zone. So again, not great. And again, when we take a look at all the indexes here, we have the Nasdaq just continuing to push and make new highs. The S&P 500 just barely ticked to new all-time highs before turning back. And then we have the Dow and we have the Russell, which are still way off of those all-time highs. So we have not had broad participation across all of the indexes. Money certainly has been concentrated in certain areas of the market and has not flowed into other areas of the market, which still kind of leads me to that this is not the healthiest thing in the world in terms of the breath readings, and we're going to jump into some analysis in on that a little bit later in the video. But first, I want to jump in. I want to take a look at the U.S. dollar. All right, we've talked a lot about that over the last few weeks, and we had a sharp breakdown earlier this week, and this looked like another potential bear flag like we saw here, right, where you have that breakdown. We had that same setup take place with this breakdown in here, and what happened? We saw a sharp reversal back up. Again, off of the Fed minutes and what was said, we saw that very sharp reversal to the upside. And it's back inside this potential bear flag range. If we were to pull back up above this 94 level, This could be looked at as a false breakdown, and I would think that we would head back up to that 95.60 zone. However, again, the dollar has been under a lot of pressure for a while. This is not by any means guaranteed that we've just bottomed here. It's really easy for us to kind of pull back up into this zone and still roll over. Major support at 91 and then 88. So we're going to continue to watch those two things. But the action that we did see out of the dollar yesterday was a really strong in terms of potential reversal, and that had a lot of impact on other commodities. Let's take a look in at gold. Gold yesterday had a huge reversal. It was another day where it was down almost $100 an ounce. The high of the day was 2020 or so, and fell all the way to 1930, so about $90 an ounce. And we also note, and I'll zoom in here on an hourly chart so you guys can really see this, we failed right at that breakdown spot from last week where we had that really other sharp sell-off day. So we had that super sharp sell-off, and then we got back a lot of that move, but we're unable to get back up over that zone. And when we start throwing in fib retrace levels on here, we didn't get back up to that 78.6 in terms of where we failed. So not exactly the greatest thing for the gold bulls on the short term, but you'll see on here the major supports in at that 1920 zone. We lose that, I would think we would test that 1880 and then go all the way back down to that 1830 where we made that breakout back in here. So gold has had a heck of a run when we look at it, and it was a very big straight up 3-week move. Taking a bit of a breather, trading sideways for a while makes sense. When we look at it on a monthly chart, we just broke out to new all-time highs. We're still holding over that zone. So nothing is broken on the long-term charts. We're just seeing a lot of volatility in the short term. Silver also very similar. Big kind of reversal there as well. On a percentage basis, yesterday's reversal was 5.5%. It doesn't look that big in context because of the move that we had the other day, where silver dropped 15% in a day from 30 all the way to 24. So volatility certainly has been in play in the silver market, but the same thing is said when we look at the weekly and we look at the monthly charts. We're still over that key breakout zone of 26 at the moment. We had a heck of a move straight up, moving sideways for a while, basing before another move would make a ton of sense. Now, we haven't taken a look at it in a while, but copper is at a very interesting point. Come in here and we take a look at this in on a weekly chart. This line right here is about right around that $3 zone. And we look at this in on a monthly chart. You can see the importance right at that $3 mark, going all the way back to 2007 and 2008. It has played a very important role many, many times over the years. And that is right where we're at. And we actually broke above the $3 zone there intraday yesterday before the Fed announcement. We'll hold over $3 to get back up over there. I would expect us to come back up and test about that 335 zone, and then above that would be that 380 zone. Copper we take a look at because usually when copper is strong, it's showing building demand because it is one of those materials that is used in building. And it kind of can show health in the overall economy in and of itself, but it also, like all the other commodities, can certainly have the influence of inflation underneath the surface. So if we are seeing that inflationary environment with all the commodities making those moves up, this might not actually be signaling economic activity under the surface from building and things. It's really that strong. It may just be an inflationary effect. Regardless, I think this $3 zone is very important and it's something we should continue to pay attention to. Now, last but not least, let's take a look at oil. Oil has, if you look at this in terms of the volatility we had in the beginning of the year, the last month or two, it basically looks like it's not even trading. It's been in a very, very tight range, and it's just holding above that 4150 breakdown zone from back in March. It can't seem to make any more real appreciation. We haven't had a big move where we're getting that push back up towards that 50 zone, and it hasn't broken down. The volatility has dried up, so to speak, and we have continued to get in a tighter and tighter wedge, as you can see right here. Eventually, we're going to leave this tight zone, and the direction that oil goes is going to be very important. If we do break down, that, of course, would be a sign economic activity under the surface and demand. It's not necessarily great. If we were to get that break up, it might signal some things in the economy actually as working better than expected. Again, we have the inflationary component to this puzzle as well. So, of course, what the US dollar does is going to continue to have a big impact in the commodity space. Next thing I want to jump in, I want to talk about breadth. We have talked a lot about it here over the last year. I think it's a very important way of looking at the market. And while we'll take a look at the Nasdaq McClellan Summation Index here in just a moment, I wanted to look at it in a different way. The S&P 500 made a new all-time high, and there was only one sector that reached a new high along with the S&P 500, which is pretty rare, and that was consumer discretionary. Was the sector that closed up at the high. But you notice we were pushing up to that high at the end of last year. You had 6 sectors at the same point in time pushing up alongside of it. So that's a bit concerning. You would like to see broad-based strength, and we're still not quite seeing that in this market. When we take a look at the Nasdaq McClellan Summation Index, what we've got going on right here is we're having breadth kind of roll over while the Nasdaq continues to make new highs. That is not a great look. When we think about what we want out of our breadth readings, we want a consistent, broad-based, across the board, a lot of different names pushing up together. And we have extreme wealth concentrated in very few names. The big companies have gotten much bigger this year. And that, when we look at it in this regard, shows us that underneath of the surface, things are not as good as we might think. So this, of course, is a concern for us. And another way of looking at this, Tuesday, when the Nasdaq made a new all-time high, only 38% of the stocks on that exchange closed higher, which is a very bizarre reading. The Nasdaq closed almost up 0.7% to a new all-time high, and less than 40% of the stocks on the Nasdaq went along with it in the same direction. That time that we've had previous readings like this, we had a lot of those types of readings in 2007, 2008, right before the market ultimately made that rollover. We also had some of those readings back in 99. But to be fair, also, when we take a look at this, we did have them in the mid-90s as well, where the stocks did continue to go higher for a while. It's not a ton of different data points, but it does continue to talk to that, man, breadth underneath the surface really is not as good as just taking a look at the indexes themselves. When we look at the S&P 500 returns, when that happens to the Nasdaq, 1 week later, we're only positive 17% of the time. 2 weeks later, we're only positive 33% of the time. 2 months later, we're only positive 33% of the time. And here's the big one. 1 year later, the S&P 500 was only positive 33% of the time, with an average down draw of 10.5%. So these are things that we are going to continue to pay very, very close attention to because just taking a quick glance at the indexes themselves is really not telling us the entire picture of what is going on. So in these videos, we'll keep looking at those breadth readings because I think they're very important, and we should definitely have a little bit of a cautionary mindset as we move forward here due to some of these issues. Of course, breadth readings could certainly pick up here in the next couple of weeks, and that can completely negate all of these things, so we'll pay close attention for you. Guys, as always, I hope you have yourself a fantastic week. If you found this information useful, subscribe to our channel so you can see it on a weekly basis. As always, if you have any questions, you want to reach out to me directly, you can reach me at mtedeschi@perspectivewealthplanning.com or reach me at 814-580-9881. I'd be more than happy to go over anything with you guys. I will see you all next week. Take